Hello everyone, a very good morning to everyone. I hope you all are fine and doing well. So in today's class, we are going to watch all the Macmillan MCQs of Module B. In this module, the name of module is Risk Management, where we learn different types of risk, and we have these chapters in our Module B, Risk Management, where we will learn all the concepts behind the MCQs of Macmillans. So let's start with the class. I hope that I am audible, my screen is visible, and you all are fine and doing well. So let's start with the class. First chapter in the module B is Risk and Basic Risk Management Framework. So first question is, investment in post office time deposit is, which option is correct here? Investment in post office time deposit is. See, if we talk about post office time deposit, this is backed up by Government of India, right? So when the Government of India is there, that means principal amount is safe as well as interest is guaranteed, right? So there is almost no chance of losing the money. So if you invest 1 lakh in post office time deposit at 6% per annum for 5 years, you will get 1 lakh guaranteed interest at the maturity, and there is no risk of default. So the correct answer is zero risk investment. Option A is correct answer here. Zero risk investment implies what? We know that government securities have zero risk. So here, zero risk investment implies, see, zero risk investment is that where the returns are fixed and interest are predictable, right? So there is no fluctuation in the no fluctuations are there in interest as well as principal. We can understand with the help of example. Suppose bank fixed deposits or government bonds that provide fixed interest. If you invest 1 lakh rupees at 6% for 1 year, you are guaranteed 6,000 as interest. That is zero risk because the cash flow does not vary. So options like zero coupon bonds or corporate bonds can have some risk, but it depends on the issuer, right? Bonds are what? Bonds are a type of loan which are taken by government and the corporates by issuing the bonds. They issue the bonds to the investors. Investors buys the bond and provide the loan to the government or corporates. But uh, in back, investors got the interest manually till the maturity, and also the principal amount, complete principal amount at the maturity. So here the correct answer of this question, zero variation in the cash flow from the investments. No variation, zero variation in cash flow from the investment. Option A is correct here. Which of the following statement is correct here? In the given one, which of the following statement is correct? See, if We're talking about the statement. What is risk premium? Risk premium is the extra return that generally investor expects for taking additional risk. The higher the risk, the more return investors demand to compensate for that risk. Suppose if government bond low risk is there, that might have 6% interest, but corporate bond of a new company might give 12% interest. So that extra 6% is the risk premium for taking a riskier investment, right? So we can say the correct answer is higher the risk, higher would be the risk premium. So risk and returns are directly related. Higher the risk, higher would be the risk premium. Which of the following statement is correct again? See, what is high risk business? Obviously, if there is a high risk business, that would need a high capital. High capital requirement is there for the high risk business. So high risk businesses need more capital as a buffer to absorb any type of losses. Investors also expect high returns if they are putting money into the risky ventures. Suppose there is a startup company may require 5 crore capital to cover operations safely, and investors may expect 20% returns. So in the startup tech company which is having high risk, so if the capital is requirement is high, so investors also expect high returns. But if a stable manufacturing firm which is generally having low risk, they require only 1 crore capital and offers 8% returns. So higher the risk in business, higher would be the capital requirement and higher would be the return expectations. So option C is correct. Here, what is the most crucial function of risk management? We know that risk management is the process of identification, measurement, control, and mitigation, right? Control and monitoring, you can say. This is the complete process of any risk management. So we can say while identification, measurement, cost estimations, these are important, but the most crucial function is controlling the risk. So the organization does not take more risk, it can handle. A bank may identify credit risk in the loans. It measures potential loans uh, loss and estimate the cost, but it gives loans responsibly, not exceeding the capacity. It controls the risk effectively. So our option first is correct here, controlling the level of risk to an organization's capacity, right? Option A is correct. These are all the function, but controlling the level of risk is very important. So option A is correct. When compared to return of equity and return on asset, RAROC is better performance measure because RAROC. If I talk about RAROC, what is the meaning of RAROC? It's risk adjusted return on capital, right? It measures the investment returns while accounting for the risk, right? So it is basically a risk-based probability measurement framework for analyzing the risk-adjusted financial performances. So ROE or ROA, they only measures the return. They only measures the return, not the risk. But RAROC considers both return and the risk taken to earn that return. Example, if bank A or bank B, bank A is having ROE which is 15%, right? That means low risk loans are there. In bank B, ROE is 15%, high risk loans are there. So RAROC will show bank A performed better relative to the risk, while bank B return is riskier. So it taken into account the risk undertaken by the organization to get the returns. So option D is correct here. Now capital charge component of pricing accounts for capital charge. So if I talk about the cost of capital, bank have to account for the cost of funds or capital when they are pricing the loans, right? And interest here is different related to every type of risk. So there is second thing is written, internal generation of capital. What is internal generation of capital? Bank earn profit that builds capital internally. This is the part of the pricing. And loss provision, bank have to also cover expected losses from the bad loans, right? So when a bank set interest rate on loans, it includes cost of capital, what the bank pays for the funds. Internal generation of capital, where we can say profit that adds to the bank's capital. And loss provision, bank have to reserve the money for loans defaults. For bad time, they have to reserve some money, they have to set aside some money for any type of loss or loans defaults. So we can say if a bank lend 1 lakh rupees, right? Internal capital generation is 2000 rupees. Cost of capital is 5000. And loss provisions are 3000. So then the interest rate charged would cover all these components. So the correct answer of this, all the statements are correct. Option A is correct, right? Then daily volatility of a stock is 0.5%. What is its 10-day volatility? 10-day volatility. We know that how to calculate the volatility. Suppose if for n-day volatility, it is equals to daily volatility multiply by under root of number of days. Now daily volatility is given 0.5%. That means it is equals to 0.005, right? And here N is given, which is 10 days. So 10-day volatility is equals to 0.05 multiplied by root 10, which is equals to the 0.0158. So if we multiply it by 100 for finding the percentage, that is equals to 1.58%. So option C is correct here, which means volatility increases with the square root of time. 10-day volatility is higher than 1 day because there is more uncertainty over the 10 days, right? So the correct answer is option C. Now the next question, risk mitigation. Mitigation means reduction. Results in reduction of downside potential, reduction in profit potential. See, reduction of downside potential, that is true, because migration or mitigation, that reduces the risk of big loans, and reduction in the profit potential, it is also true because some strategies can also reduce upside like hedging. So buying an insurance policy on inventory protect against any type of loss that reduces the downside. But if prices rises dramatically, insurance may cap up the profit, it reduces upside. So all of the statement is again correct here. From 1st of April 2020, RBI has mandated the banks to link their interest rates on retail loans to an external benchmark developed by Dash or to RBI's repo rate. See, from April 2020, RBI required banks to link interest rates on loans to the external benchmark. External benchmark like RBI's repo rate. The benchmark rates are developed by Financial Benchmark India Private Limited, right? And what is this benchmark? Benchmark rates are basically those rate which is a type of interest rate set by the central bank or financial authority, right? Which is basically used to calculate it, loans, mortgages, and the investments. And the purpose of these rates just to determine the minimum interest rates bank charge, allowing for transparent, market linked, and floating interest rate. So suppose if repo rate, RBI repo rate is 6.5%. Now what is repo rate? Repo rate, reverse repo rate. So repo rate is basically is the rate which is interest charged by the RBI on short-term loans to the commercial banks, which is basically given to control inflation and managing the liquidity, right? The repo rate is that rate, or we can say repurchase rate, in which the interest rate at which central bank lends money to the commercial bank when there is a shortage of the liquidity. So suppose if the RBI repo rate is 6.5%, right? And bank can also offer the repo plus 2%, which is 8.5%. So any change in repo rate automatically affects the loan rate. So the correct answer is here FBIL, benchmark, financial benchmark India Private Limited. Now, risk in banking business. Financial risk means when there is a talk of loss of money, when the loss related to the loss of money. So what is financial risk? See, financial risk covers all the uncertainties that may reduce profit or even cause losses. It is broader than just cash flow changes. If a bank faces interest rate changes, that reduces net interest income. If a company has investment in a stock, a sudden fall can cause losses. So we can say the correct answer is uncertainties resulting in adverse variation of profitability or outright losses. Option A is correct. Right? Now, the next question, strategic risk. Strategic risk is a type of C. Strategic risk arises due to wrong business plannings, poor decisions, as well as failure to adapt market changes. Strategic risk is completely related to the bank, how they take the decisions for their bank, right? So completely related to the wrong business decisions. Suppose if a bank launches a product that failed to attract customers. So losses due to the decisions are called strategic risk. And here the option given, interest rate risk. Interest rate risk is completely occurs due to the fluctuations in the interest rates. Credit risk is occurring due to the when the borrower is not able to pay the interest or principal. Liquidity risk is completely shortage of cash, not availability of the cash, so bank can fulfill their obligations. So here we can say strategic risk is none of these because it comes due to the wrong business plannings, poor decisions. So option D is correct here. If a bank funds its assets from a pool of composite liabilities apart from credit and operational risk, it faces which type of risk? See, when the basis risk occurs, when there is a mismatch between maturity of assets and liabilities. Suppose if a bank have deposits for 1 year, 5 years, and bank lend the loan for 20 years, home loan, right? So that 15 years difference is the mismatch because bank is only having deposit for 5 years and bank lending for 20 years. So there is a mismatch of 15 years. So it will face basis risk. Strategic risk is completely from the poor decisions. Reputational risk is just because of the damage of the reputation of the banks due to different types of issues. Compliance risk is not following the rules and regulations. But basis risk is that when there is a mismatch between the rates of assets and the liabilities. Other risks are from the different categories. Suppose bank borrows at MIBOR plus 1% but lends only 7%. If MIBOR changes, profit may vary. And what is MIBOR? MIBOR is a benchmark rate. So the correct answer is here option 1, basis risk. If a bank sanctions rupees 1 crore loan to a borrower, which of the following risk the bank is taking? 1 crore loan. See, if we talk about the liquidity risk means when the bank needs cash, if the borrower defaults or if the need of the bank is cash. Interest rate risk is when the loan rate is fixed, interest fluctuations affects the earning. Market risk is generally applies to the securities, not the loans. Credit risk, borrower may default. Operational risk is error in the documentation, fraud, or any type of uh, loss due to people, process, technology failure, and some external events. So market risk is not directly relevant for a standard loan, but all these three, liquidity, credit, operational risk, are present. So we can say option 145 is correct. Third option is correct. Premature payment of a term loan will result in interest rate risk of type premature payment of term loan. See, whenever a borrower prepays the loan, in that case, lender expects losses, right? So this is embedded in the loan contract as a prepayment option. Suppose loan of 1 crore at 8% for 10 years. Borrower prepays in third year. So bank loses interest for the remaining 7 years. That is called embedded option risk. So option C is correct. Embedded option risk. If an entity has a credit sale of rupees 20 crores for the financial year ended 31st March 2021, the profit on the sale is 10%. The entity has booked a profit of 2 crore as on 31st of March 2021 on the credit sale before actually getting the cash flow from the debitors. For the statement, it can deducted that the firm is following which type of accounting. See, accrual system of accounting records the income when earned, not when received, right? Cash accounting records only when cash is received. We can take the example here. Suppose here credit sale is 20 crore, right? And profit is 2 crore, which is booked on 31st of March 2020, right? Even here cash is not received. That is called accrual system. So which option is correct? Option C is correct. Now the very important chapter, risk regulations in banking industry. Systemic risk. What is systemic risk? It is one of the dangerous risk. Why? This risk can't be controlled, can't be managed, and can't be diversified. In this type of risk gives the chain effect rule. Means if one bank fails, that impacts on another banks also. So that systemic risk is basically occurs when the failure of one bank or financial institution triggers the failures in others that affect the entire financial system. It is completely different from individual or isolated bank failures. So 2008 global financial crisis started with the collapse of Lehman Brothers, but caused a whole worldwide banking crisis. That is systemic risk. And systemic risk is generally failure of entire banking system. Option D is correct. Right? Now, central bank governors of G10 countries participate in the Basel Committee on Banking Supervision. How many total number of members are there? See, Basel Committee on Banking Supervision originally established on in 1974 by the G10 central bank governors, which now consist 45 members from 28 jurisdictions. While founded by G10, the committee expanded its membership significantly in 2009 to 2014 to include more countries. And currently, we have the countries from representatives from the Argentina, Australia, Belgium, Brazil, Canada, China, European Union, France, Germany, Hong Kong, Singapore, South Africa, in etc. So we can say there the correct answer of this question, Basel Committee includes central bank governors and bank supervisors from 13 member countries, which is originally G10 plus Switzerland, Luxembourg and Spain. So the correct answer is option 13. In 1988, Capital Accord framework accounted for 1988 Capital Accord. So if I say some uh, few words of this Capital 1988 framework or Capital Accord, that is basically known as Basel I, which is introduced by the BCBS. Why? Just to strengthen the stability of the international financial system. And there is a minimum capital 8% for internationally active banks, which are primarily focuses on the credit risk, right? So credit risk is accounted here, but market risk is included in 1996 amendment. Operational risk is what? Failure of banks due to uh, basically people failure, process failure, and some external events. Operational risk is completely added in Basel II. No place is there for operational risk is Basel I. And defined capital component, yes. Basel I says that 8% is mandatory. So the correct answer is the 1988 Basel I framework primarily addressed credit risk. Market risk was recognized later. Operational risk later in Basel II, and it defined the minimum capital requirement for the banks. So the correct answer is here option A, D. That means we can say here option 1 and 4 is correct. So option second is correct because market risk and operational risk is completely different in this, but we can say the correct is credit risk and defined capital component. But in the 1996 they are starting addressing the market risk, so this answer is correct. Back testing. What is back testing and why this back testing is done? Back testing. If I give you the overview of back testing, back testing, you can say it is a type of strategy which is basically using historical data to evaluate the performance, profitability, and risk before investing real capital. So, backtesting is check that if a risk model is able to give or predict the accurate outcome, like value at risk model. So risk model that basically predict actual outcomes or not. If predictions are different from the real results, model adjustments are needed in that case. So bank predict daily losses of 1 crore using value at risk model. If actual losses are 3 crore, the model fails backtesting. So what is the main aim? It's aim to compare model results and actual performance. So option B is correct here. Under Basel II, capital requirement under the accord is capital requirement under the accord. Basel II provides guidelines for minimum risk, and regulatory authorities, RBI, set exact requirements for the banks. If RBI may say a bank maintain 9% of risk-weighted asset as capital, so that is the mandate level. So the capital is specified by the regulatory authorities required to be maintained. That is mentioned in the Pillar 1 currently in Basel third, because we are following Basel third norms now currently. But under two it is mentioned in Pillar 1 that banks have to maintain minimum capital requirement, and that is uh, directed by the RBI. Option C is correct. Capital charge for credit risk require input for PD, LGD, EAD and M. Under advanced IRB approach, who provides the input for LGD, loss given default? So if I give you the overview of PD, LGD and EAD. PD is probability of default, right? Loss given default and exposure at default. These are the very core components which is used in bank and finance to quantify the credit risk and calculate the expected loss. Probability of default that estimates the likelihood that the borrower will fail to meet the debt obligations. Loss given default that estimates the percentage of exposure that a lender expects to lose if a default occurs. An exposure at default predicts the total outstanding amount a borrower is exposed at the time of default. So here we can say under the advanced internal rating approach, bank estimate LGD, also PD and EAD, right? Using the internal model. So supervisors only review the bank methodology. They do not provide the values. So the correct answer is here bank. Under the standardized approach, the rating assigned by the eligible external credit rating agencies, which will largely support the measure of, if there is a talk of ratings, then that means they are talking about the credit risk. What is credit risk? when the borrower is not able to pay the loan to the bank, either principal amount, either interest rate. But before sanctioning a loan to a borrower, bank checks everything just because to avoid credit risk. Bank checks or evaluates the borrower financial stability, financial background, payment history, repayment history, past repayment history, and also the stability of the business. Now, these things are done by the credit rating agencies, and these credit rating agencies assign a rating to the borrower according to the factors that is checked at the borrower level. So, external credit rating agencies helps the borrower or supports the measure of credit risk only. So option B is correct. We know that market risk is when the adverse movement are there in the market that affects the market. Liquidity risk when there is a shortage of cash. Operational risk is when there is a failure due to people, process, system, and some external events which are beyond the control of banks. So bank use ratings from the agencies to calculate capital requirement for the credit risk. It does not directly affect market liquidity and operational risk. So option B is correct here. Under the RBI Basel III norms, the domestic systematically financial banks will be plotted into dash different buckets and would be required to additional common equity tier capital requirements. See, what are these domestic systematically important banks? We know that these banks are very large level of banks, complex banks, too big to fail, right? If these types of institutions trigger or fail, that will cause a major economic crisis because they are too big to fail, right? So in this, they are required to maintain common equity tier 1 capital buffer to manage higher risk. So these are classified into 5 buckets based on systematic importance. Higher the bucket, higher additional common tier 1 capital requirement. So how many buckets are there? 5 buckets are there, right? In which different things, different percentage are mentioned. So we can say the correct answer is option A. Now we are starting market risk. If an 8-year 8% semi-annual bond at a basis point value at rupees 125, the yield on bond has increased by 5 basis points. So what is the profit or loss suffered due to increase in yield as the holder of the bond? So how to calculate? We know that here basis point value is given rupees 125. That means price changes for 1 basis point change in yield. Here yield is increases by 5 basis points, right? So how to calculate loss? Loss is equals to basis point value and change in yield, which is equals to rupees 125 multiply by 5. That will give you 625, right? So since yield is increased, bond price fall here. So there is a loss, which is the loss of 625. Holding a bond with 1 lakh after 5 basis point yield increase, you lose rupees 625. So the correct answer is option D here. If 1 day value at risk of a portfolio is 5 lakh with 95% confidence level in a period of 6 months, how many times the loss on portfolio may exceed 5 lakh? So what is value at risk? Value at risk is basically a type of model or a measure which helps in measuring the risk of loss of investment or capital. It estimates how much a set of investment might lose. So here at 95% confidence, 5% chance loss exceeds value at risk on given day. So over 125 days, we can say exceed is 0.05 multiply by that 125 because these are the working days. So we got 6 days here. 6 days here. That means on average 6 out of 125 days losses may exceed 5 lakh. So option C is correct here. Now, if a bank suffers a loss due to adverse market movement of a security, the security was, however, held beyond the deficiency period. Which type of risk here the bank will suffer? So what is the meaning of this deficiency? Deficiency period is basically a type of period which legally defined time frame during which a borrower can replace the collateral on a loan with the portfolio of government securities. So they can prepay a debt without any type of penalties, right? So uh, that means in the given type of risk, the options are given. Market risk is just because of adverse movement in the market factors. Operational risk, credit risk, market liquidation risk. Now, market liquidation occurs when the asset is sold or held for too long, right? And price changes lead to the losses. It is different from normal market risk because timing of sale cause the additional loss. If suppose a bank is holding a bond expecting to sell it after 1 month but hold it for 3 months, market price drops, that will cause the loss. So option C is correct, market liquidation risk. If a bank holds a security that is rated A+, the rating of the security migrates to A. What is the risk that the bank has faced? Only the one risk if the in that type of risk, in that type of situation, if A plus to A, that means deterioration in the credit quality, right? So if there is a deterioration in the credit quality, there is a chance of credit risk. There is a chance or in the chances increase that the borrower will default. There is something fishy with the borrower. So credit risk is the risk that the borrower issuer downgrades or default. Drop in rating signals highly likelihood of default. So corporate rate bond is A plus. A market views it riskier, which is potential for default. So here credit risk is realized. Option D is correct. If a bond with the remaining maturity of 5 years is presently yielding 6%, its modified duration is 5%. What is the Macaulay's duration? What is the formula of Macaulay duration? That is, uh, Macaulay's duration is equals to modified duration plus 1 plus yield to maturity. That means here if we calculate, uh, yield is given 6%, that we can write 0.06, right? So that means 5 divided by 1 plus 0.06, which will give you 5 divided by 1.06, that will be equal to 5.3 years. So option C is correct. 5.3 years. Now, value at risk is not enough to assess market risk of a portfolio. Stress testing is desirable because, what do you mean by stress testing? Can you tell me the meaning of stress testing? See, this is a technique which is used to evaluate how the financial institution, portfolios, companies perform under the extreme scenarios. It helps in um, evaluating the weakness and also assess that if the capital is enough, and measures the risk resilience just to take action to mitigate the potential risk. So value at risk assumes normal market condition that may underestimate the risk in extreme scenarios. But stress testing simulates extreme market events to see the potential loss. So value at risk shows maximum loss of 1 crore with 95% confidence. But stress market simulates the 2008 like market crash, prepares banks for extreme risk. So it helps in assessing risk due to abnormal market movement of market parameters. So option C is correct here. Now conditional value at risk is also called, what is the meaning of conditional value at risk? So if I say you the conditional value at risk, that measures the average expected losses in the worst case scenarios, right? And that basically a type of measure that quantifies extreme losses in a portfolio. So we can say that is also called expected shortfall. Option A is correct. Now let's talk about credit risk. Which of the following is not a type of credit risk? Default risk, yes, it is a type of credit risk in which the risk of borrower not paying. Credit spread risk, yes, that is also related to the market value of credit. Intrinsic risk, not a standard type of risk. Basis risk can be associated with the interest rate mismatches. So we can say here, which of the following is not a credit risk? That is intrinsic risk. Credit risk is about borrower's ability to repay or loss due to the downgrade default. So option C is correct, intrinsic risk. Risk of a portfolio with overexposure in steel sector will be If suppose bank is giving only the loans to the steel sector, so that is always more than systemic risk. Why? Because systemic risk, we know that is the market wide and cannot be diversified, cannot be managed. But if bank is only giving exposure to the steel factor, that adds unsystematic, which increases the total portfolio risk beyond the systematic risk. So it is more than the systematic risk. Option first is correct. The risk arises due to worsening of credit quality is the risk which is arises due to the worsening of credit quality is credit spread risk. Why credit spread risk? Because credit spread risk always arises when the perceived credit quality of the borrower deteriorate, right? But intrinsic risk is the default probability. Portfolio risk is diversification effect and counterparty in which one party is not able to fulfill the agreement or their obligation. Suppose if a bond is A plus is downgraded to A, bond price drop, bank loss value, credit spread risk realized here. So the correct answer is option second, credit spread risk. In order to develop our capability to actively manage our credit portfolio, one must have in the place of following credit rating model, develop and maintain necessary data on default of borrowers rating category wise, rating migration. So which of the answer is correct? C. What are the requirements to actively manage credit portfolio? Credit rating model is required because that need to assign risk level, need rating migration history just to track any type of changes and to refine the risk management. If bank monitor borrower using internal rating model and tracks that how many migrated from A plus to B, that can proactively manage the portfolio. So in that case, we can say both options are correct. Option A and option B means first is correct. The model that combines 5 financial ratios is one and only Altman G score they are talking about. Altman G score basically combines 5 financial ratio using reported accounting information in equities value to produce an objective measure of borrower's financial health. Let me tell you about the Altman G score in some more detail. So Altman Z score is a formula-based weighted metric which is developed by Edward Altman in 1968 to predict the probability of the company going bankrupt within 2 years. It basically uses working capital to total assets and retained earning to total assets, EBIT to total assets, and market value of equity to the total liabilities and sales to the total assets. So it produces numerical measure of bankruptcy risk. And what is the formula of this? Z is equals to 1.2a plus 1.4b plus 3.3c plus 0.6d plus 1.0e. This is the formula, and there this A, B, C, D are the 5 different ratio. What is the safe zone? If the Z is below than 2.99, that is low probability of bankruptcy. Gray zone, if Z is more than 1.81 but less than 2.99, that means moderate risk of insolvency. And distress zone is when Z is basically when the Z is here less than 1.81, there is high probability of financial distress. So the correct answer of this one is Helpline Z-score. A transaction where financial securities are issued against the cash flow generated from the pool of asset. See, whenever they are talking about the pool of assets, so they are only talking about one concept, that is securitization. Securitization is the financial process of pooling the illiquid assets such as mortgages, credit card debt, and converting them into the marketable interest bearing securities. So securitization, bank convert the loans into the marketable securities and investors receives cash flow. So the option first is correct. As per the RBI norms, in case of residential mortgage-backed securities, the minimum retention requirement for the originator of securitization transaction should be dash of the book value of loans being securitized irrespective of the original maturity. So, very simple. Is here that originator have to retain at least 5% of the book value of the securitized loan. Why? To ensure they share the risk. So if suppose bank insures 100 crore mortgages, they have to retain 5 crore on its book. So see, direct answer is option B. Now operational risk and integrated risk management. Operational risk is that much dangerous that can open the mouth of that person. So operational risk arises from one is locked because of inadequate or failed internal process, that is confirmed. Then we have people and system are on the peak because due to frauds and technology failure. External event, yes. Defaults and market price fluctuations, these are the part of the defaults are the part of credit risk. Market price fluctuation is the part of market risk, right? Default, credit risk, market price fluctuation, market risk. So we know that what is operational risk? One of the dangerous risk that is occurs due to the people failure, process failure, system failure, external events which are beyond the control of bank. So suppose if a bank teller enters wrong transaction, operational loss. IT system crashes, operational loss. Earthquake destroys the branch, operational loss. So A, B, C is correct here. Option third is correct. The international convergence of capital measurement and capital standards recommended for operational risk. Here, see, bank recommend the event-based classification. Why? Because in this we can include internal fraud, external fraud, employment practices and work safety, client products and business practices, damage to the physical assets, business disruption and system failure, execution, delivery and process management. So loss due to fraud, internal fraud event category. So option C is correct here. Benefit of an integrated risk management framework are: integrated risk means combination of all the risk and management of all the risk in one go. C. Integrated framework ensures risk adjusted decision making across the bank operation. If bank is setting aside capital which is for the risk, price loans become better and they can decide which risk is used to hedge. So the correct answer is all of them. These all are important for a integrated risk framework. Reward of proper management of operational risk are rewards. What are the rewards? I think you can expect all of them. Why? Because reducing operational risk means lower required capital, cuts the cost, improves the reputation, competitive advantage. So all these are the correct. Option C is correct. Sorry, I is correct. All of them. Now, probability of occurrence is given, potential financial impact, impact of internal control, what is the estimated level of operational risk. So nothing to do, just apply one formula, which is probability multiply by impact multiply 1 minus control effectiveness. So what is probability of occurrence here? 4 multiply by 4 multiply by 1 minus 0. 4, 4, 16. 4 multiply by 4 is 16. That means risk level are usually mapped to the 0 to 3. 0 to 3, in 0 to 3, 16 is there. So option A is correct. That means high risk, level 3. What is the beta factor? Beta factor is 15%. Because when the under the Basel, sorry, here it is for corporate finance they are asking na, and I told you basic indicator approach, because in that we have to, that is alpha. In this for corporate finance 18% is there, because in the standardized approach operational risks are divided into the 8 business line, and from that we have corporate finance which is having 18%. So we have to learn these all the percentages, because trading and sales includes 12%, retail banking 12%, commercial banking 15%, corporate finance is 18%. That is the process involves key risk, bank assessment of its operation activities against an already listed menu of potential operational risk weaknesses. When the bank do own assessment, that is called RCSA. Key risk indicators are the early warning signals. Internal control factors, whatever the bank can do on their internal level, and external control factors are controlled externally. But the RCSA is the internal process where bank evaluate operation process control against a predefined menu of operational risk. It helps identifying the gaps and prioritize the mitigation measures. So the correct answer is option A. Overall responsibility, whenever they are talking about overall responsibility in every risk, they are talking about the board of directors, because these are the overall persons who are responsible for managing the risk. They are able to ensure that the bank has proper policies, limits and oversight. So other committees manages the risk, but bank board of directors have the ultimate responsibility. So with the closed eyes, always choose option A. The role of deciding the transfer pricing policy of a bank and making liquidity cost and benefit an integral part of bank strategic planning is performed by ELCO, because ELCO manages funding, liquidity, interest rate risk. It sets the internal transfer pricing, which decides cost benefit of liquidity between different business units, and it helps in integrating liquidity strategy with the overall banking. And what is transfer pricing? It is a technique in which rules, methods, prices applied to the transactions between the related entities within a multinational corporation. So ELCO is the answer here. Temporary assets do not include cash. Temporary, because cash is the uh, you know cash is the dirt of hand, so that is temporary. Current asset, bill purchase discounted up to 1 year, 1 year, temporary. Investment up to 1 year, temporary. Intangible assets, not temporary. These are long term assets like goodwill. These are non-liquid and also long term assets. So option D is correct here. In the risk management framework of the risk, which risk is called as fatal risk? Fatal risk means liquidity risk. Liquidity risk means ICU for the banks. Liquidity risk when the bank does not have enough cash to meet its obligation. So it is called fatal risk. Even the bank is profitable on paper and it is unable to pay the depositors. Bank collapses. So the option B is correct. True and false. Now you can see that true and false is like looking like doing the party. So first, banks are not required to strive to achieve a higher ratio than the minimum prescribed above as an effort better towards liquidity risk management. Who said this? This is completely false. If the bank is able to maintain more than uh, the minimum prescribed capital, they can maintain. Banks can maintain if suppose the minimum liquidity that LCR is prescribed, but banks are maintaining high ratio, that is not a big problem. If a minimum LCR is 100%, bank can maintain 120%. So this statement is completely false. LCR is a ratio of stock of HQLA. Yes, stock of HQLA and the net cash flows over the next 30 calendar days. Obviously true. This is the correct formula. Stock of HQLA divided by net cash flows. Stock of HQLA means all the high quality liquid assets which can be converted into the cash quickly, and net cash flows, difference of cash inflow minus cash outflow, multiply by 100. It's ensured bank has can survive short-term liquidity stress. So this statement is true. Basel third framework prescribed two monitoring tools metric for better liquidity, better monitoring a bank liquidity position in addition to the liquidity standards. So this statement I think false, because I'm sorry, this statement is correct because we have two tools, contractual maturity mismatch, contraction of funding. This statement is true because we have two tools. LCR needs to be monitored only in home currency? No. LCR should be monitored in all the significant currencies if the bank operate in multiple currencies. and each currency has its own cash flow outflow assumptions. So this is false. Retail deposit include all demand and term deposit, including bulk deposit, excluding foreign currency deposit, placed with the bank by a natural person. False. Retail deposits are the deposits from the natural person, excluding bulk deposits, usually more than 5 crore, and foreign currency deposits. So 2 crore fixed deposit from a corporate, not retail, and 1 lakh saving account, retail. So this statement is also false. Now total stock of HQLA 60 crore. So how much bank can have in the form of level 2B assets? See, level 2B assets means 15%, which they are talking about 6,000 crore. Now, if I give you the overview of this HQLA, yeah, let's see. We can say these HQLAs are the highly quality liquid assets, right? Which are divided into two levels. Level 1, level 2. Level 2 is also into two parts. Level 2A, level 2B, right? So level 1 including cash, very highly quality type of assets, and 0% of haircuts are there. But in level 2, 2A 15% of haircut, and in level 2B 50% of haircut. And basically this level 2, yeah, so level 1 assets is 0%. So here the answer 15% of 60 crore is 9,000 crore. Option C is correct here. 9,000 crore. Right? Now, okay. So you can join our Telegram channel also for more updates. That name is CAIIB by Aishwarya Sharma. You can join this for more updates, and I hope the things are clear. That is, with this we completed module B of the Macmillan questions. If you like this session, kindly give the like and subscribe to the channel, comment to the video. If any problem is there, you can ask me, I will solve your issue. So thank you so much. Let's meet in our next class. Till then, take care and have a good day. Thank you everyone.